Tonight, thank you very much for coming to the webinar this evening. We've got Matt Penfold and Paul Correa from Fiduciary Wealth Management. Great to see you, fellas. How are you doing?
Really good, Carl. Thank you. Really good. Yes.
Excellent, excellent. So Matt, if I can introduce you, Matt, advisor and director at Fiduciary Wealth. You've been working in financial services for 20 years, having spent the last 4 years working in Gibraltar, but living in Spain, just on the other side of the border there, having relocated from the UK. UK is your background. Paul, managing director, MD and co-founder of Fiduciary Wealth. Paul, extensive years of experience in financial services with a strong private banking and wealth management background. In 2007, he co-founded Fiduciary Wealth, partnering with Isolas, 1892, the oldest law firm in Gibraltar. Aside from their legal roots, Fiduciary Wealth is a member of MGI Worldwide, and they're a top 20 global network of accountancy and tax advisory companies, concentrating their service in 4 jurisdictions: the UK, Gibraltar, Spain, and of course, Portugal. Fiduciary Wealth's goal is simple, and that is to offer unbiased expert advice to deliver solutions and outcomes for their clients. Should we get underway, gentlemen?
Absolutely. Let's do it.
As people may have heard earlier on, the Nostradamus of the wealth management world here. Certainly, Paul, you and I have had some great conversations about where things are going, and at very interesting times that we're currently seeing in the UK. So a very interesting and important time to be talking about wealth management. Yeah. When somebody, then let's ask the first question. Sorry, go on, Paul.
In an official environment, we're called Nostradamus. We also refer to as the Chaco Brothers. So it depends on the setting, yeah.
Very important to our friends.
To me. Okay. When someone focuses on relocating abroad to somewhere like Portugal, which is the first question tonight, they often overlook the importance of exiting their home country properly. This is from a fiduciary financial point of view, of course. Can you let everyone know why that is so important and possible implications of getting this wrong? What does exiting the home country probably mean when it comes to your finances and your wealth?
It means basically exiting the UK in a clean tax year, which would be 5th of April, let's say, of 2023. I think that's really, really important, and I'll cover it in greater detail. But there's many different factors which will determine whether you're deemed UK tax resident or not. The number of physical days you spend in the UK clearly is a key consideration, but it's not the only factor. So you need to consider things like the pattern of your presence and your connections with the UK once you leave. Things like family connections, property, your working life, and any social connections you may have, clubs, associations, and so on. Right. And what determines whether you're a tax resident or not is the UK State Residency Test 2013. And that allows you to plan the date in which you become non-UK resident, and determines, in fact, how many days you can spend in the UK without accidentally re-triggering tax residency. It's always advisable, as I said, to exit at the end of the tax year, which is the 5th of April, because it's a clean break and it's easier. However, you might decide to go for a split tax year between the UK and Portugal, for instance, and there's 3 specific situations where split tax year rules automatically apply. Otherwise, you need to go back to HMRC, and there's a bit of ambiguity when you've exited. So the 3 key considerations normally are, are you leaving the UK for full-time employment in a third country? If you're not, is your spouse or partner seeking employment in a third country? And if that fails, have you sold your main residence and no longer have access to accommodation in the UK? If you can satisfy any of those conditions, then you can have a split tax year, which means rather than end of the 5th of April, which is, as I said, much cleaner, then you could say it might be, 30th of June, for argument's sake.
Okay.
So the UK State Resident Test then has ties as to, depending on the number of ties you retain in the UK, determines how many days you can go back to the UK without re-triggering residency. So there's 5 different ties, and then we need to go through them and determine whether it's a tie or not a tie. So it's not too difficult, it's quite straightforward. 1 or 2 of the ties can be a bit ambiguous and subject to interpretation, but otherwise it's clear. So that's why it's so important, because people leave the UK and then say, yeah, but I want to be non-habitual resident in Portugal, but live in the UK. Typical statement, isn't true that? Or yes, but I've got my parents that are still, you know, elderly, and I need to take care of them. Or my children are still in school in the UK, and actually my wife will be there taking care of the grandchildren. That's another one. And I'll be back and forth. How many days? Well, I don't know. The starting point should be, if you move to Portugal for argument's sake, how many days are you planning to stay in Portugal? You need to do 183 or more.
Yes.
And how many days are you planning to go back to the UK for? And what is your travel plans on a global basis? Yeah, to make sure you don't trigger in another country which is not the UK and Portugal. So that's why the UK statutory residency test is so important and is often overlooked. You can be penny wise, but pound foolish.
Yes.
Because you go online and you think you understand everything and you don't.
Yes.
And I see it constantly, and Matt does as well, I think.
Yeah, absolutely. Yeah.
Yes, so it's complex, but not complicated necessarily, and clearly the realm of professionals who you should consult to find out exactly when you qualify, when you don't qualify, and the amount of days you need to be here or there. Because of course, these countries don't do this for our benefit or your benefit, do they? They do it for their own benefit, and you have to know exactly what is going on and how you fit into that scheme, even though it may sound very advantageous. So check with the pros, and make sure you exit and return correctly. You know, exit your home country properly and manage your return hither and thither. That's great, Paul. Thank you very much for that. So when somebody has done that, yes, given that the complexity of what we're talking about tonight, we will take questions at the end, and we'll open up the chat at that point, or find a way certainly by then for you to ask questions, everybody. So bear with us. We will ask a few questions first, and then we'll get to your personal inquiries a little bit later on. Once that's taken care of, as you described it, Paul, do you no longer have to worry about what's going on in the UK? I suspect not.
Unfortunately, you're still caught by UK tax rules for inheritance. So the good news is you move to Portugal, and there's no Portuguese succession tax between direct descendants or ascendants. In other words, if you were to predecease your parents and they are the beneficiaries, then there's no Portuguese succession. Yeah, right. So that's brilliant. The bad news is, whereas in Napoleonic law countries like Portugal, Spain, France, Italy, inheritance tax is based, or succession tax is based on the concept of tax residency. In the UK and countries like Ireland, it's based on the concept of domicile. Now, domicile is something you acquire at birth, and it's normally taken from your father. So where was your father born? Where were you born? And whilst you can claim and acquire a domicile of choice by settling in another country with the intention of staying there permanently, this is always fraught with difficulty. There are no fixed rules, and the burden of proof always falls on the taxpayer to prove they've acquired legitimately a domicile of choice. Yeah. And in any event, let's assume that this was done to perfection. And very often it isn't. But let's assume that in our experience with Brits, it's not uncommon for a British couple or an individual to return back to the UK either permanently or temporarily, either due to ill health for a year, because they want to go to be treated by the NHS or privately rather than in Portugal. That act of going back and becoming tax resident for a year, even if you've correctly adopted a domicile of choice, then that undoes all the planning. Yeah? Then you fall back definitely, regardless. And often you return permanently when the spouse passes away. So the couple, one of the spouses passes away, they're left on their own, they want to go back to the UK. So even 1 year of UK tax residency will re-trigger UK domicile. Now, theoretically, you can avoid UK inheritance tax after 5 years of non-UK tax residency. But in practice, it's much more complicated than that. And you have ties such as, again, what I mentioned, business interests, your social connections, your family interests, do you have property? And then there's something which is the all-encompassing clause, intentions. What are the intentions? That can be enough to be construed as being domiciled in the UK. So, as I said, even insignificant ties can be challenged. Yes. HMRC have been known to rely on the most tenuous of grounds to dismiss that an individual has correctly acquired a domicile of choice. And the most high-profile case is that of Richard Burton, the late Welsh actor. He lived in the US for many, many years. He then moved to Switzerland in 1957. He spent the next 27 years in Switzerland only to pass away in 1984. He had had Packer advice from a top tax practice in London. The UK tax authorities made an inheritance tax claim on his estate on the grounds that he never relinquished his UK domicile. And they argued that notwithstanding the fact that he had severed his UK ties 30 years before and had done it correctly by the book, he was caught by something called, which I've just mentioned, what were his intentions. They claimed that the fact that he had purchased a burial plot in Wales and he retained the emotional ties with Wales means that he always intended to return back to the UK. And apparently, the basis of the claim, HMRC's claim, was that because he was buried in the colours of the Red Dragon, in red, with a copy of Dylan Thomas' poem, this is true, he never relinquished his UK domicile. So he had an estate of 5 million, which was a lot of money in 1984. He had, well, when I say he, his estate had to pay £2.4 million in inheritance tax. Wow. So a 5 million estate ended up being 2.6 because of the concept of domicile. The good thing is, if you've been outside the UK or you're a non-UK tax resident, it does open an umbrella of opportunities to restructure your financial and tax affairs, to mitigate or completely eradicate UK inheritance. It's all a question of planning, but you can't leave it too late. You just can't leave it too late, because then there's no opportunity to plan it properly. You have to execute it early on.
Okay, so a lot of I dotting and T crossing to be done here.
Exactly. So, there's opportunities to address that issue.
Yes.
But you can't leave it for the last minute, yeah? It can't be something you do in your deathbed and you start planning, with hours to go, right? Let's do this.
Perhaps, yes, perhaps better to got your affairs in order a little bit sooner than that. Okay, so this idea then, happy go lucky, moving to Portugal, and you're in Portugal, you don't have to worry about the tax situation back in the UK. Not true. Yeah, wherever you come from, I guess you have to be aware of the tax situation back home as well as where you've ended up. That would just be good practice. Is that all you want to say on that, Paul, for the time being?
So do you think I've said enough?
Well, we're going to do as much as we can to demystify and make it as uncomplicated as possible, and bash a few acronyms tonight as well, I suspect, too. Talking of acronyms, NHR. Non-habitual residency. This is one of the very attractive, or seem to be one of the attractive tax benefits of Portugal. I think this is your area, Matt. Would you care to tell us a bit about the benefits of the NHR?
I will, thank you, Carl. And before we go into the tax benefits, I guess it's worth saying a couple of things. Firstly, this is a webinar for information purposes.
Yeah.
We can detail some of the taxation, but we said it earlier, people should get kind of proper advice from the profession directly. Everyone's situation is different. Yeah. If you're basing all your tax affairs on one webinar, it's probably a kind of foolish move to make. And we talk about the NHR. You're right, Carl, there's lots of benefits to the NHR. Paul kind of covered it briefly. You do have to be living in Portugal to benefit from that. Mm-hmm. We get a lot of people and they say, oh, I've got the golden visa, I'm going to spend 14 days in Portugal, but I've got my NHR, so I'm not going to be paying much tax. It would be nice if the world works like that, but it's not the case. You spend the minimum time, the 183 days, and then you get all those lovely tax benefits. So I'll cover them in brief. So employment income is taxed at a flat rate of 20%, but that's on the basis that your occupation is what they classify as a high value activity. Mm-hmm. So there's various occupations, they have a nice vague-ish list that they've got, but if it's covered by that, flat rate of 20%. The other thing that I should ask is, I should add is that NHR is based on the concept of double taxation agreements, which Portugal has with many countries.
Yes.
We would focus on the UK one today, but it works on the basis of the taxation agreements between the two countries. Mm-hmm. So taking that into mind, foreign source income is exempt for tax in Portugal as long as it's deemed taxable in the country that income derives. Yeah. So one that's very important for that, I mean, we can include things like rental income in the UK, that's deemed taxable in the UK, therefore under NHR, there's no further taxation in Portugal. One that's a very big draw for individuals moving to Portugal under NHR is dividends. And it's a bit of a quirk of the double taxation agreement between Portugal and the UK, in the sense that Portugal deemed them taxable in the UK, the UK deemed them taxable where you are tax resident, and therefore it's potential to receive dividends at a 0% tax. So for people in that position, it's a very, very attractive part of the NHR. Another one is pension income, which is taxed at a flat rate of 10%, but that could be benefited from an even lower tax rate, which we'll cover briefly later. And the main one that's not covered by NHR is capital gains tax. And we often think it's overlooked. Did they do that for a reason? Did they miss it out when planning NHR? But capital gains tax is relatively high in Portugal, it's 28%. And that makes no difference if you're under the NHR scheme or you're a tax resident, a normal tax resident. So capital gains tax is one that needs a lot of planning amongst all the other things, but otherwise 28% is a high rate to pay on that. Okay.
Is that all you'd like to say about the NHR at the moment? Because I want to put that in the context of this whole concept of tax planning. We might assume we know what that means as punters. What does it mean from your side as the professionals? Obviously, Paul was saying, you've got to get the ducks in a row before you even get started, before you move. You've got to remember the picture back home and not just think you've signed it off. What else is involved, as you see it as the professionals, when it comes to tax planning and how the NHR would fit into that, Matt?
Well, we see the planning is a key part of it. So plan as far advanced as possible. Now, we might have people here who already live in Portugal.
Yeah.
Our recommendation is always to plan before you relocate. There's certain options that you can take advantage of. But I wanted to talk about a few of the tax planning opportunities there are.
Yeah.
So the first one we will cover is something called a QROPS. There's an acronym for you, Carl.
Yes, yes. Don't worry, everybody. We're going to be doing all of these. It's QROPS, QNUPS, and PCB will all be covered tonight, won't they?
We will cover them, yes. So it's Qualifying Recognised Overseas Pension Scheme.
Yeah.
There you go. I hope everyone's jotted that down. And the QROPS, because I'm not going to pronounce the full thing, we'll be here all night, is an option to transfer your UK pension overseas. And there's a few reasons an individual might want to do that. For those who are very close to the UK lifetime allowance, which is a limit to how much you can hold in pensions before being taxed rather aggressively. If you can transfer your pension to a QROPS before you breach that limit, then your pension can continue to grow without this aggressive taxation. With the QROPS, it's offshore, so it's out of UK legislation. Now, UK pension schemes, if you pass away age 75 or over, then your beneficiaries will have to pay tax at their marginal tax rates when they receive that pension. So we're talking 20, 40, 45%. who knows, depending on what the budget is doing that week and what U-turn they do. Whereas a QROPS, your beneficiaries can take that income at the same beneficial tax rate, which leads me nicely on to, we mentioned pension income is at 10% under the NHR. Now, a QROPS, and there's certain caveats with this, and it's a conversation that we'd have to have directly with an individual because it depends on how their original pension was funded. But it is quite possible that if structured correctly, that income can be taken, so only 15% of the income is taxed. So you have 15% of the income taxed at a 10% tax rate. So it's an effective rate of 1.5%. So it's a very, very efficient way somebody can draw income from their pensions in Portugal. Now that's if you've got a pension that you might want to transfer while you relocate. Now, Paul talked earlier about inheritance tax in the UK and how you relocate from the UK and you think you've shaken off that, but no, you continue to be exposed. Mm-hmm. Now, there is a product that's available for expats called a QNUPS, Qualifying Non-UK Pension Scheme. Now, a QNUPS is similar to a QROPS in the sense that you have money inside that, there's no capital gains tax. It benefits from the generous tax rate, so potentially 1.5% on that. The big difference between the two is that a QNUPS is funded from a lump sum investment. So you've got some money from savings and inheritance that you built up, maybe some investments in the UK that you've liquidated. Now, a big draw is that if that is set up as a legitimate pension scheme, then any money that you place inside of the QNUPS is immediately outside of your estate for inheritance tax. And that works even if an individual returns back to the UK. So inheritance tax in the UK is 40%. So there's a potential huge saving there. Now, I did mention that it has to be a legitimate pension scheme. And what we mean by that is, you know, you're a 75-year-old, you've got 5 million in assets, you say, great, this sounds brilliant. I'll put 4 million in a QNUPS, no inheritance tax on that. That doesn't work because it's clearly an IHT, inheritance tax fudge. Mm-hmm. But for somebody a bit younger, they don't have kind of pension provisions, they can make an investment there and it can be a kind of great saving. And the last one I will get to not go on too much, is the last acronym, the PCB, yep. Portuguese Compliant Bond. So in the UK, or other countries, we're used to certain tax-efficient investments, ISAs, investment bonds. Now, the Portuguese Compliant Bond is the closest alternative for expats living in Portugal. And we talked about the capital gains tax rate at 28%. For someone who's invested in a Portuguese compliant bond, there's no capital gains tax until you make a withdrawal. And then if you hold that money in the Portuguese bond for a certain amount of time, the tax rate you pay on withdrawals reduces over time. So it starts at 28%, but if you've actually held the money in there for 8 years, it reduces down to 11.2% on the withdrawals. So it's another good way of saving tax, reducing it over time.
Can I just add something?
Of course, Paul, yeah.
It's 11.2, but the capital, let me go back. After 8 years, it's true, you pay 11.2, but only on the gain. So I'll give you an example. Let's say that you invest 100,000 euros in a Portuguese bond, and it grows to 150,000. So there's a 50% gain, right? So now it's the 100,000 has become 150,000. So you could argue that you could split it into 3 blocks. Two-thirds is the initial capital. 1/3, 50,000 is the gain. Now you make a withdrawal after 8 years. So you're taxed. When you make a withdrawal of say 30,000 euros, they'll say 2/3 is return of capital, no tax. 10,000 is 1/3, the increase, yeah? That is taxable at 11.2. So if you get 11.2% on a third of the withdrawal, divide 11.2 by 3, and the effective tax rate is 3 point something. So actually, it's the headline rate is 11.2.
Yeah.
But in essence, so long as there's capital to withdraw, the rate is fantastic, I think.
Absolutely.
Single figures, yeah?
Yeah, and those products we give as a headline, the latter two for people looking for investment options, but there's an additional benefit of those that is often unknown. And there's call it an issue, but in Portugal, if you sell your property, you buy a new property, no capital gains like most countries. But the issue is if you sell your property and don't rebuy, or you sell your property and downsize, then there's a taxable element of the gain on your original property, the one they've sold. So you have, if you want to avoid paying that gain tax, there are two options. The first one, you sell your property and then you buy one of equal or greater value. Or if you sell the property and you want to downsize, the excess of the gain, if you invest that in a qualifying investment, which is equivalent to the Portuguese compliant bond R, then again that eliminates that capital gains tax. So it's an additional way.
Sure, but if you do, I mean, this is the thing we're talking about here, is that you can't make assumptions, can you? Because even though they might seem fairly safe and intuitive or intelligent assumptions, let's say you were wanting to downshift and come to Portugal and release a load of cash from your equity, you might end up with a big capital gains tax challenge if you don't enter into one of the schemes you just described.
Yeah, I think, yeah, you're right. Assuming is I think there's a saying, isn't it? It makes an ass of you and me. But
yes, indeed.
It's a big mistake, and I think Paul said earlier, you can Google something and think, oh, that sounds about right. Or I go on Facebook, but there's a lot of rubbish out there, and we're talking about potentially large tax bills are similar for people, and why they wouldn't take individual professional advice, I don't get, because there's a lot of hurdles that people can hit on the way. So I think a mistake people always make is as well, you're used to taxation in your own country, you've lived there for a long time, and you just kind of presume it's the same, or I'll be okay, and life's never that simple, I'm afraid.
So true. And I saw a bloke talking about it on a Facebook group. Is not good enough either. Get some professional advice, folks. You're talking to some pros tonight here. Yes, Mike, was it Michael? Yes. Not seeing the usual chat. That is the case. There is a Q&A button that you can press, and we can take questions that way. That's probably the best way to do it tonight. And thank you to those people who've done that. Glenn, for example. Rob, thank you for your help there. Glenn, Michael, and Milan asking questions. We might just deal with this if we may for a moment. Somebody's asking if the income from a US company would be tax exempt for the NHR. We're talking about UK people here tonight, aren't we? In the jurisdictions we described to save people time.
It's very specific. I think the best thing is that they approach us afterwards.
Yes.
And then we can engage.
Yes. Okay.
It's very straightforward. We can give an answer here and then.
Okay.
Otherwise, it's better to engage. But our area of expertise is really British nationals moving to Portugal.
Yeah, okay. Well, we'll come back to those and we'll do our best to answer them, but do bear that in mind, folks.
But can I just mention something? Because I mentioned UK pension transfers into a QROS, Qualified Recognised Overseas Pension Scheme. And whereas it makes perfect sense for a British national who's accrued UK pension benefits to consider that option, to transfer those pension benefits into a qualifying recognised overseas pension scheme for the reasons that Matt outlined earlier. But there's a few headwinds that facing UK pension transfers. One of them is that there's a new UK pension transfer regulation introduced by the UK in November 2021, less than a year ago, called the UK Pensions Schemes Act 2021. And basically what it does, it enables UK pension seeding schemes. By that I mean the trustees of your UK pension in the UK, whether it's a SID or whether it's a company pension scheme, it allows the trustees to refuse a UK pension transfer on the basis that there's an increased risk of pension scamming. Now, in reality, it's just an excuse, yeah? I think the UK pension industry has lobbied the UK government and applied a lot of pressure. Of course, there's pension scamming, and it's good that there's regulations in place to prevent that. But very often it's just a delaying mechanism to get your pension assets transferred across, because I think Matt has said it many times before, you gain some tax allowances from saving into a UK pension scheme, only to transfer the pension out when you're drawing income and paying money to the UK tax, to the UK exchequer, right?
Yeah.
So you get the tax relief, but then when it comes to paying tax on your pension income, you transfer it down, and some other country benefits from taxation. So it's a kind of a slowing mechanism. So it's becoming more difficult to get the UK pension transferred to a suitable overseas pension structure to improve your tax efficiency. It doesn't mean you can't do it, but the processing times are getting longer, and there's more due diligence involved, and the process is delayed, yeah?
Yes.
It can drag on, sometimes 6 months, it can last up to a year. So I think people, when they think, oh, I'm moving abroad, I'm going to delay my decision until, once I settle in the country. Well, actually, QROPS and QNOPS legislation allows you to transfer a pension 12 months before you leave your home country. So if you're planning to leave the UK, you should really start doing it now, because the pension money is not going to be available until a year from now. And during that period, you're in limbo. So that's one thing to consider. The other point to consider is that the post-Brexit economic reality, yeah? The UK is no longer bound by the 4 freedoms, including the free movement of capital. When we were in the European Union, we were bound by the free movement of capital, including pension assets, yeah? So in 2017, the UK government introduced something called the overseas transfer charge. And basically what it said was, if you are transferring your pension assets to a country outside the European Union, or it's outside the European Economic Area, so it's the EU plus Liechtenstein, Norway, Luxembourg, and Gibraltar, and you transfer money out into those territories because you're moving and establishing tax residency there, then there's no 25% overseas transfer charge. Or if you're moving to a country where your pension trustees, the QROPS trustees and administrators, are in the same country where you live. So let's say that you move to Cambodia, which is not the EU or the EA, right? If the pension trustees are administering your pension scheme from Cambodia, then there's no overseas transfer charge. But of course, there's no expertise in countries like Cambodia, yeah? And they're not on the list of approved QROP schemes by HMRC. So that doesn't work. So really, you're limiting yourself to EU/EEA, where you still avoid that overseas transfer charge. But as I said, things have moved on. The UK is no longer part of the EU, and they could decide to extend that overseas transfer charge and say, you know what, from this day on, the EU and the EA are captured by this OTC of 25%. We are not bound by any EU rules. We are not bound by the 4 freedoms, including capital. There you go. So if anyone is thinking about delaying that decision, they shouldn't. They have to consider that opportunity might close. Nothing stays the same. And remember that countries are desperate for revenue.
Yes, I was going to say that. I was going to ask.
They're desperate for revenue, and they look at every single loophole and say, you know what, I'm closing down.
Yeah.
So
25% of what, Paul?
Of the pension that you're transferring. So
really? Right.
Yes.
So that it's like an exit tax, effectively, then.
Exactly.
Absolutely. That's exactly what it is, an exit charge.
Wow. Okay. Some people might be glad to have heard about that tonight, which is save them a lot of money. Okay. Fascinating. Anything else then when it comes to transferring? Any other caveats?
No, the only thing I would say, Matt touched on the lifetime allowance, and just to say that you could be caught by the lifetime allowance charge and by the overseas transfer charge. The only relief there is that, you know, once you pay a lifetime allowance charge, I think the OTC charge is based on the lower amounts. Yeah. But besides that, you know, it's a double whammy, which you try and avoid, yeah?
Thank you for pointing that out. Okay, well, let's go to the last of my questions, if we may, and then we'll throw it open to the Q&A that's been coming in. Thank you, everybody, for being patient and waiting and putting your questions in the Q&A section of the Zoom tonight. One piece of advice, then, you'd give anyone looking to move to or already living in Portugal. I can sing the praises of living here. It's fantastic. But what would you say, Paul?
Well, I was with Matt in the neck of the woods in João de Barquinhos, I believe it is, and it's amazing. And then we went to Tomar. Yeah. So what's not good about Portugal? Tell me. So look, it's amazing. You move to an incredible country, but it's always a bumpy road. And you need a trusted advisor by your side that can make that journey easier for you and ensure that it's a smooth and seamless transition to a new country of residence. Failing to plan is really planning to fail. You need a timeline, you need a strategy, and you need an advisor that will help you execute it, because it is so easy to miss key steps along the way. And if you're not properly advised, missing one key step can be a very costly mistake. Yeah. This is why I keep saying you can be penny wise, pound foolish. Yes. You think you save money, you Google, and then you find you haven't followed the right order. It has to be done meticulously. I always say, plan first and move later. And this is not a race. You know, you can be the tortoise rather than the hare. This is not about speed. This is about making sure that you take the right steps in the right order. And I finally go back to the issue of IHT. When it comes to IHT, it's always advisable to plan for the worst. Assume that you're going to be liable and hope for the best, because as we explained earlier, and we gave the example of Richard Burton, a negative posthumous decision by HMRC can really reduce the inheritance of their children. Yeah, absolutely. And it can be, it takes a chunk away, you know, 40% of what you've built your wealth over an entire lifetime with the intention of using it to enjoy your lifestyle in retirement, and then pass on the remainder of your wealth to your children, only to find that the taxman is rubbing their hands and taking 40% away, right? Well, that's right. And it's pretty horrific, the picture you described there, which is a precedent, isn't it? It's some more time in the past, but I don't suppose things have got any better since then. And as you said, it's up to the taxpayer. The onus is on them to meet the deadlines. And I imagine, given what you said as well, that, you know, nation states will be looking to raise income and from taxation. They won't be especially charitable with mistakes, or err on the side of in favor of the taxpayer. It will be all on the side of the nation itself, won't it? And its revenue, taxation and revenue generating arm or department. So pretty sobering, that, Paul, but nice to know people are in good hands if they go with you at Fiduciary Wealth Management. Should we go to some of the Q&A questions now? Is that okay with both of you, or is there anything else either of you wanted to add, Matt or Paul? No, I think the message is, you know, do things properly. I mean, I'm an expat myself. I remember the excitement of moving across, and I think it's understandable people can get carried away. I mean, we touched on it. Portugal is such an amazing country, and the lifestyle is so incredible. You get excited by that side of it, but you still need to do things properly. Yeah, I always say sand, and sangria, the three S's, can cloud your judgment. So before you get the sand and the sangria, yes, get your house in order, and then you can cloud your own mind. Yeah, but make sure you do it correctly. Get that sorted out. Yes, failing to plan is planning to fail, as you said there. Okay, Rob, thank you for your earlier comments. That's really helpful. Glenn, I have a UK power of attorney for my mother. Can I set up a Portuguese power of attorney for her
and for myself before we move that? That's more of a legal question than a taxation one, isn't it?
Absolutely. It's
Right.
a legal question. I think it's beyond our remit.
Yeah.
I would think that you can set one up in Portugal. I don't think your power of attorney in the UK has any validity, but
I think you're right, Paul. And
it's just I'm not sure.
yeah, have a chat with Gilda or Daniel Reyes, of course, if I may say that, in the Expats Portugal Business Directory. Thank you, Glenn. Oh, and another question from you. My father passed away recently. Sorry to hear that, Glenn. Can funds in a UK trust be transferred to Portugal, either to a trust or not? My mum is descended from Portugal. She does not speak English, and her care needs to be there and not in the UK. With that inheritance then from the father, which is what I think the question is, whether it comes to a trust or not. Of course, it can be moved to Portugal, can't it? But
well, I think this is a question that we're happy to deal with privately, because with common reporting standard, trusts are looked through.
okay.
So there's reporting anyway. So the trust in the UK or Jersey, wherever, then whenever there's a distribution of trust monies and the common reporting standards, the trustees are legally obliged to make that reporting to the home country, which is then shared universally amongst the 100 signatories of the common reporting standard.
Okay.
And it will be shared with you where you're tax resident. So, and in fact, there's an obligation by the trustees to report if any of the wherever the beneficiaries are. For each individual beneficiary, that could be in different countries, they will report.
Complex.
So I think, who asked that question?
This is for Glenn.
So I think Glenn should get in touch with us, and we will be happy to look at that in greater detail to determine what's the best way of doing that. But I don't think a trust would give him an advantage. But remember, a pension is a trust, but not a trust in the traditional sense. Okay. So it's a very good question, Glenn. I think we're a bit blindsided because we haven't got the detail, and it's a private matter. We're happy to engage with you and discuss it in greater detail if you're interested.
Yeah, of course. And the way to get in touch with you, we haven't covered that. How should people get in touch with you?
Just drop us an email. Drop Matt or I an email, and we'll take it from there.
Which is?
Inquiries, yeah. So inquiries at fwm.gi.
Yeah.
GI for Gibraltar there. So inquiries at FWM.
I just say that it's referenced the webinar today.
Yeah, please make
otherwise it gets screened by someone else, and I think we can circumvent that when the email comes in. Yeah.
There you go, Glenn. Drop Paul and Matt a line. Inquiries at fwm.gi. GI is the suffix for the emails to FWM. Milan was asking, if I pay capital gains tax in the UK, say at 18%, as a resident in Portugal, would I be liable for an extra 10%?
That's pretty much it. So there's the double taxation agreement. Yeah. But the capital gains tax, we covered it earlier, and NHR really doesn't protect you from that. So it's exactly that. You pay the difference. So Portugal does give you a credit for what you pay in the UK. So it's a very simplistic way of saying that, but yeah, effectively the additional 10%. Okay, well done, Milan. And Michael, thank you for this. I indeed moved to Portugal from the UK, but it's time to close my UK company, isn't it? I don't know if that's a comment on what's going on in the UK at the moment, or whether that's a request for advice on closing a company. Would you step into that, somebody's business life in that way as well, in terms of advising them, or is that more of an accountancy matter, the advantages of closing or not closing a UK company? So is that the question? Should he close? Yeah, should he close his company? Is it time to close? Is it time to close my UK company? I think with Michael again, I think that's a question he should approach us directly, because he's given us a snippet of information, and on that basis we're supposed to give an opinion. Yeah. Well, it depends on Michael's overall background and what he's trying to achieve. Yes. What UK company does he have? What income does it drive from that? Is it dividends? Is it income? Yeah. I think there's a multitude of questions that we need to ask him. I don't think on the basis of a one-liner
we can really give.
Oh, fair enough.
No, I think there can be benefits to retaining the UK company because of the way the taxation works. But for us to say, okay, but everyone keep your company, but everyone get rid of it, it's
there will be pros and cons, and those need to be balanced up in a bigger view, I think, Michael. I hope that helps. Rob is in Canada, going to the Netherlands for a year at least, living off retirement income. No need for employment. Wife has EU passport. Feel that we will just maintain Canadian ties for a year or so. So a question is, I think you can probably see this as well, can't you, at your end in the Q&A? If after 2 or 3 years we feel that Europe should be the new home, can we slide into a Portugal, this is for you, Matt, into a Portugal NHR scenario without living there full time? If we spend 181 days there, then the rest somewhere else. Could we significantly minimize our retirement income taxation that way? There's a whiff of the golden visa as well here, isn't there, to be considered possibly? But what do you make of that, Matt? Especially that.
I mean, there's a lot to unpack there, Cole.
Yes.
So there's a residency that you need to establish. I think you talked about the wife has an EU passport.
Yes.
So therefore, maybe there's an easier way to gain residency. But we feel that Europe should be the new. Can we slide into Portuguese NHR scenario without living there full time? If we spend 181 days there, well, the minimum is 183.
Right.
So you're very close to the limit there, Rob. But no, there's two things to say there. You have to spend the minimum time to gain the NHR, provided you have residency as well. And we didn't really cover that before, but NHR is a tax scheme. Some people think it's a right to residency. And this comes up more now post-Brexit because, Brits need a visa. You need the right to residency first, then you can apply for your NHR. But you need to spend a minimum amount of time there, but also be careful where you're spending the rest of your time, because if you're looking to spend the least amount of time in Portugal but still enough for NHR, where are you spending the rest of your time? Because you may accidentally trigger tax residency somewhere else, and therefore, if that happens, you're paying tax there, and the benefits of NHR are effectively lost.
It's exactly what I covered in my first intervention. What are your travel plans? And in which countries are you going to spend time? Yeah. Meeting the Portuguese threshold of 183 days doesn't mean you don't trigger residency in a third country. Okay. So yes, from a Portugal perspective, do more than 183, absolutely. If Rob is then planning to travel extensively without staying in a third country too long, it could work. But again, the devil is in the detail. We would need to sit down with Rob and establish his travel plans, and say, this could work. Which countries are you spending time in, and where are your assets based? Where's your main residence? So potentially it could work, but we would need more information from
There
Rob.
you go, Rob. Need to get into that long grass with Paul and Matt and discuss the detail there and see what's what. But I think there is certainly something to go out there. Enquiries at fwm.gi. Sauranon. Hi, I'm from Ireland and own a property in France. In 3 years' time, I'll have owned the French property 20 years and will have no capital gains to pay in France. If I move to Portugal and avail of the NHR, will the double taxation treaty apply? And will I have no capital gains to pay in Portugal either? Best regards, Tom. Cheers, Tom, for that.
Well, our expertise is not France / Portugal.
Yeah, I think Tom's kind of hit the nail on the head in the sense that will the double taxation treaty apply? But it depends on the double taxation agreement between the French and the Portuguese. And that double taxation agreement will effectively answer that question. That will say, okay, in this sort of situation, this is how the taxation applies.
Because Matt is absolutely right. Double taxation treaties are not the same. Yeah. They are specific to the two countries that have entered into the agreement.
Yes.
And in some countries, they'll deal with one item of income in a particular way, and in another completely different. So you have to go back to the double taxation treaty between France and Portugal and determine the application of tax, provided there's clarity. Normally there is.
And so speak to a French accountant about that.
I think so. No, Matt, on the French side.
I think
before
so.
looking at the Portuguese end.
Yeah.
Because it's instigating in France, isn't it? So presume I'm certainly no expert on this, but is that what you would do? You go to a French accountant?
I think in that situation that you probably need to kind of find a specialist who knows
both countries.
A bit on both sides. Yeah.
Yes.
And that's what we always say. We understand the Portuguese and the UK side, so we can put it all together.
Yeah.
Whereas I think that individual needs to have someone who can kind of understand both sides.
Yeah, there you go, Tom. You need to get somebody who knows how those two countries work together, or this country and France, this country being Portugal, of course. Thank you for that question, Tom. Coming back to Michael, using a UK personal limited company to take income from the UK under the NHR, tax-free in Portugal, is okay for the long term. Well, the 10 years, of course, for which the NHR is applicable. Or have the CFC rules issues as UK, have they changed? Have CFC rules changed, I think is the question here, given that the UK is outside the EU now?
The fact that we Brexited doesn't really affect that, because the double taxation agreement, we keep going on, but that's the basis of the NHR. So Brexit hasn't superseded that. Yeah. They retained the same agreement between the two countries, and double taxation agreements aren't between the EU. You know, you can have one between the UK and the US, or Portugal and Australia, or whoever. So Brexit happening, I'm right in saying, hasn't made a difference on that one.
But Michael could take rather than income from his UK company, could take it as a dividend in Portugal.
Okay.
But I think with Michael, we agreed that it would be beneficial, given the issues that is raised, to have a chat with us. See whether we can be of any
Same email address again, Michael, enquiries@fwm.gi. And CFC rules, I only know that as Chelsea Football Club. That's not what that means here. What is CFC in this context?
Well,
I have no idea.
Michael, tell us. You're not talking about Chelsea Football Club there. If you could let us know what you're referring to there, that would be very helpful.
I thought it was only us three that could use acronyms.
I think that question was revenge.
No, it's okay. No, it's fine. Foreign controlled company. So FCC, I guess, rather than CFC. Thank you for that, Michael. Thanks for that clarification. That's great. That's all the Q&A there. Has that triggered anything else for you, Paul and Matt, whilst we've been talking there?
No.
I think it's kind of reiterated a lot of what we said earlier, in the sense that, I mean, there were some really interesting questions, and I think it's individuals who, I can see why they come to the webinar, because they have certain issues that they need advice on. So I think we would say to those people, reach out, explain your situation, because we don't give a one-fits-all response, because we want to do things properly.
Yeah, thank you for that. There is another question. Carl, a question for you. What is your background? And you're not referring to my green screen that you saw earlier on, are you? That's for another time. Join me on the Good Morning Portugal show and ask me that question, Milan. I'd be delighted to answer that. But tonight, your stars are Paul Correa and Matt Penfold here from Fiduciary Wealth Management. Thank you so much. Unless there's anything else to add, thank you for that, for your presentation, for sharing what you know on the subject of moving to Portugal and the advantages and what people really need to know, rather than making all those assumptions. Last word to you both then.
No, I think we just say thank you for having us, Carl, and for hosting this. And thank you for everyone who's joined us.
It's a pleasure.
Yeah,
it's a pleasure. Big value to the Experts in Portugal network, community.
Always good to talk to you.
Yeah, hope we've given some valuable tips and things to consider, which
and if you haven't made a note, inquiries, if you haven't been able to note that down, inquiries@fwm.gi, you can find Fiduciary Wealth Management in the Business Director of Expats Portugal. I've always enjoyed our chats, but maybe now this isn't the context for this, but I've always enjoyed our chats about the economic situation in the world. It's especially spicy at the moment, is it not?
I'm waiting for another invite for the Olympics.
Okay, so now is perhaps not the time.
Listen, I'm longing to go. I'm just waiting.
Yes.
So as soon as you invite me, I will share my views on the market, because I think Actually, I think it would be a very good timing. We're in London next week.
Yes.
For the British Chamber of Commerce Portugal London exhibition moving to Portugal.
All right.
The following week we're back. And as I said, if you want to invite me, I'd be happy
Awesome.
to share our thoughts on the global economy, inflation, global debt, direction of financial markets, supply chain disruptions, all these issues, and
energy, precious metals. How long can they keep printing money? All of that.
Exactly.
We will all talk about all of that in due course. Thank you everybody for tuning in tonight. Thanks, Paul. Thanks, Matt. Bye for now.
Thank you.
Thank you, everybody. Bye-bye.
Bye-bye.